June 12th, SpaceX begins trading, and within the first few minutes, something predictable is going to happen. The price is going to jump, maybe 20%, maybe 50%, maybe more. And the second it does, your phone is going to light up. Group chats, finance forums, people you went to school with, everyone saying the same thing. Did you get in? Here's what I want you to notice about that moment. Nobody in that group chat will mention that Rivian opened up 22% on day one and then lost 2/3 of its value over the next year. Nobody will mention that Reddit looked like a disaster on day one, dropped straight out of the gate, then climbed nearly 150% over the following months. Same energy, opposite outcomes. The opening pop told you exactly nothing in both cases. So before June 12th turns into a decision you make in 30 seconds based on a number moving on a screen, let's do the math everyone's skipping. Let me be upfront about what this video is and what it isn't. This is not a video about SpaceX being a bad company. By almost any measure, it's a remarkable one. It launches more rockets than entire nations combined. Its Starlink satellite network now reaches over 160 countries. If you came here looking for someone to say the rockets won't fly, that's not this. This is about something sharper. The difference between a great company and a great investment at a given price on a given day. Those are not the same thing. And the gap between them is exactly where ordinary investors lose money on deals like this one. Over the next 15 minutes, we're going to look at 4 things: what the business actually earns, what the price is asking you to believe, who's standing in line ahead of you, and what the calendar quietly has planned. By the end, you won't need me to hand you a verdict. You'll be able to run the numbers yourself. Let's start with the business, because the headlines won't. In 2025, SpaceX brought in about $18.7 billion in revenue. That's a serious company by any measure. But here's what gets buried. In that same year, the company lost roughly $4.9 billion. Not a startup, not a pre-revenue bet, a company doing nearly $19 billion in sales running at a loss. Now here's the part that surprises most people. When you buy a share of SpaceX, you're not really buying a rocket company. The rockets are no longer the main story. The single biggest part of this business is Starlink, the satellite internet service, which generated about $11.4 billion in revenue last year, roughly 61% of everything. And more importantly, Starlink is the only part of this business turning a real profit, about $4.4 billion in operating income. The launch business? Growing, but slowly. The AI division recently folded in, burning cash, not making it. So picture it this way. You're buying one engine that works, Starlink, towing several heavy cars behind it that don't yet pay their own way. There's a reasonable case those other cars become valuable someday, but someday is doing a lot of work in that sentence, and the price being asked of you assumes someday is already here. One honest note before we go further, the $18.7 billion revenue figure includes the AI business for the full year, even though it only joined partway through. Strip that out and the picture leans even heavier on Starlink. Either way, the conclusion doesn't change. One engine is doing almost all the real work. Now the number. SpaceX is going public at a $1.75 trillion valuation. Most coverage will say that and move on, let the sheer size do the talking. But the most revealing part isn't the size, it's how fast that number got there. In mid-2025, SpaceX was valued in a private share sale at around $400 billion. By the time it goes public, that figure is $1.75 trillion, a 4.4 times increase in roughly 11 months. So the business underneath must have grown enormously, right? It didn't. Revenue grew about 1/3. The rockets didn't get 4 times better. What got 4 times more expensive was the story. Here's how to actually feel how stretched that is. At $1.75 trillion against $18.7 billion in sales, you're paying roughly $94 for every single dollar of revenue this company brings in. 94 to 1.
for a business that is currently losing money. Most large, profitable, well-run companies trade somewhere between 3 and 12 times revenue. The market's biggest growth darlings rarely sustain anything close to 94. And this isn't my opinion. One of the most respected independent research firms on Wall Street ran a detailed valuation and concluded SpaceX is worth roughly $780 billion, about 55% below the IPO price. Notice something about that number. $780 billion is almost exactly what SpaceX was privately valued at just months ago. The entire run-up to $1.75 trillion happened in the window right before the public was invited in. Now let's ask the only question that actually matters. Forget predicting whether it goes up or down. Instead, what would SpaceX have to achieve just to make buying at this price worth it? Let's set the bar as low as we honestly can. Forget getting rich. Just match what you'd have earned doing the lazy thing, buying a plain index fund and forgetting about it. Call that around 10% a year. Start at $1.75 trillion. Growing at 10% annually for 10 years means SpaceX would need to be worth roughly $4.5 trillion a decade from now. Fine. What does the business have to look like to justify $4.5 trillion? Even using generous assumptions, assume by then it's a mature, admired company trading at a healthy multiple of sales, the math demands something like $566 billion in revenue, up from $18.7 billion today. That's roughly 30 times current revenue. To get there in 10 years, SpaceX would have to grow at around 41% every single year without stumbling once. Almost no company at this scale in history has ever done that. That's faster for longer than almost any technology giant you can name managed in its single best decade, starting from a base of nearly $19 billion, not a garage. And remember, that result is what's required just to tie the index fund, just to break even against doing nothing. There's one more layer to this, and it's the one that catches retail investors most reliably because it's printed in plain sight months ahead of time, and people still get blindsided. When a company goes public, insiders, employees, early investors, founders can't immediately sell their shares. There's a lockup period. The reason is simple. If everyone who bought in cheaply could dump shares on day one, the price would collapse instantly. But here's the thing about a dam. The water doesn't disappear, it just waits. SpaceX has built something more intricate than the usual single release date. Instead of one moment where the dam opens, it's a series of timed releases. A meaningful chunk of insider shares can start hitting the market just a couple of days after the company's first earnings report as a public company, likely landing in late summer. More batches free up at regular intervals after that. The founder himself has agreed to hold for a full year, which sounds reassuring until you realize nobody else is on that schedule. And notice the cruelty of the timing. Those first releases arrive right as the opening excitement is wearing off, when the headlines have moved on and the crowd of eager buyers has thinned. Fresh supply, fading demand. That combination is exactly what pushes a price down on a schedule the insiders could read months in advance.
So where does that leave you? There are two loud options. The first is to chase the hype. Buy on the day the price pops at the end of the relay right before the supply waves arrive. We've now seen, step by step, why that's the weakest seat in the house. The second is to dismiss the whole thing forever, which throws out a genuinely extraordinary business on principle. The third path is quieter, and it costs you nothing but patience. A few months from now, SpaceX will have reported real earnings as a public company, actual numbers on record you can hold it to. The forced index fund buying will have run its course. The first waves of insider selling will have washed through. The price will have had a chance to settle at a level set by the business, not by a countdown clock. None of that requires you to predict anything. It just requires you to not be in a hurry. The best companies of the last few decades stayed viable for years. You did not have to own Apple, Amazon, or Netflix on day one to do extraordinarily well. The market rewards the patient far more reliably than it rewards the early. The single most transferable thing from this entire video isn't any one number. It's the question, not what will it do, but what would it have to do to be worth it? That question works on every stock you'll ever consider, not just this one. SpaceX is a great company. That is not in dispute. But at $135 a share, you're not buying a great company at a fair price. You're paying today for a near miracle and only getting the index fund's return if that miracle fully arrives on schedule. Watch the open on June 12th if you like. Just don't mistake the noise for a reason. I'll see you in the next one.